But let me welcome on board our guest for today, Feroze Azeez. Needs really no introduction. Good afternoon to you, Feroze, Deputy CEO at Anand Rathi, for those who need that introduction. But Feroze, talk to us. 4.8% on the US 10-year, that's been breached. What are the other downside risks to markets as we see it, which can play out over the next year or so? Because we are seeing markets very close to their all-time highs.
Yes, absolutely, Harsh. Of course, the 10-year Fed rate is at 4.8. If you look at the average of the last 10 years of the 10-year Fed rate, it's 2.2. So we are trading at about 150% greater in the US market. If you compare that with an Indian parlance, the 10-year GSEC average for the last 10 years is close to about 6.8. We are at 7.3. That's just less than 10%, and there you have 150% rise. That's point one. So this is a big risk, but I think India has been a beneficiary of this risk. In fact, about 8-9 months back, I had gone to Boston to meet some fund managers who manage few $1 trillion. I tagged along with somebody who was big enough for me to get an audience with them. And it was very surprising that most of them bet that US will slip into an induced recession, and they were heavyweight India. Because the problem the globe is grappling with is business as usual for us. We have operated with a high interest rate economy for long periods of time, high inflation. So I don't see that as a big risk. And if you look at the correlation between yields and the cash flows of FII, the correlation is significantly lower this time around, which proves the hypothesis which those fund managers were saying it in English. That's point one. The second risk which I see is immense complacency in the market, especially the derivative market. It's very shocking. In my 18 years of sitting on a terminal from a derivative standpoint, the implied volatilities have never been so low. For example, if you go to a June 2024 put, which encompasses an election, is 19,000 put is available at 1.5% of Nifty's value, 300 rupees, 350 rupees. This means that the options traders are pricing in as a seller significantly lower volatility than what should actually imply. If an election year is there, any election year would, this same option, if I would have seen 3-4 general elections from 2004, you would see implied volatilities anything more than 22, 23. Just because of that one day of the election result when the market can move 10% up and down. The second risk which we see is the breakage of the volatility from the range. India has thrown up lower volatility than S&P 500 because of the option trading volume going significantly up. Once that breaks, then there are a lot of people who are going to burn their fingers, and then the volatility shooting up will be significantly more. That's the second risk, which is not being spoken about too much. I'm emphasizing it because that option, to my mind, with an election year should be priced at 900 rupees. And it's priced at 350 rupees. Insurance on markets can't come so cheap with an election year after a rally of about 16% on the index this financial year. So that's the second risk, which is a little out of the box. It's not a fundamental risk, but technical risk because the option volumes are so large. Everybody seems to have made money writing options, and there's a certain degree of complacency in that high volume, which is apparent to naked eye.
Right. And are you seeing some of those risks more on the higher side when it comes to mid caps and small caps? You, for yourself, have done very, very well in your small cap portfolio. You shifted well at the start of this year. So are you now suggesting that some amount of money be taken off the table when it comes to small and mid caps? How are you viewing some of those valuation trends?
Small cap, I think there's some more meat left there.
Okay.
As the election takes the center stage, there could be some flight of capital. But if you look at the small cap index, especially from a mutual fund investor standpoint, the NSE 250 small cap index has some large heavyweights, top 10 heavyweights. Some of them are complete momentum stocks, like Suzlon is the largest weight. It is on upper or lower circuit 7 out of the 10 days. That's because it is an ASM 4, additional services margin 4, which
Correct.
makes the limits 5. So point I'm trying to make is still the liquidity is going to drive this segment. You don't have to quit the game. Now, how does one know and be ahead of the curve with respect to the liquidity in the small cap mutual fund, for example, because DIIs buy a lot of small cap, FIIs buy a lot of large cap. We've actually devised an algorithm which tells you what was the index, what was the money flow in the small cap index yesterday. Small cap funds yesterday, and you would see that there is 1,000 crores which has come into the small cap funds, which is not released by Amphi. It happens every month. In the first 11-12 days of October, working days of October, we have seen about 1,000 crores coming into the small cap index. Still this number remains positive. It will be difficult for the Nifty to outperform the small cap index. So how do I know when I would book my profits from that 35% in small cap back to 5, which was the call taken? We went right. God has been kind, but it's very important to know when to quit. And I think till the tide of liquidity turns, you would want to take the ride and be ahead of the curve before the tide turns.
Understood. Got it. Are you also, from an FII standpoint, you of course went and met, investors in the US, in Boston, as you correctly mentioned. What's the mood like over there? Because you're seeing the US 10-year head consistently higher, even though at every point people are asking questions as to whether this is the top. So where do you see the top here? And what's your sense based on everyone that you're meeting?
I think after a certain point, every rise is going to be so much more difficult. So I don't see that on a sustained basis, it can ever be more than 5. Sustained basis, if I have to put a mathematics to it, a 1 month average. We look at average of the 10-year yields rather than the specific point. If the averages moved, 1 month moving average moved more than 5, I would be very, very surprised.
Sure.
It will not happen. So if we are at the top, point 1. Point 2, every time it rises, they're closer to that. That implies that there is an opportunity for you to buy equities.
Understood.
Third, I personally think that from a domestic standpoint, we have seen that there is a strong correlation between FII short positions if they in the futures market, if they cross 80, those are times to buy. And I've backtested this, and this is one of the best predictors of the short-term move. If FII long and short, which I'm sure most of us track, I tried to backtest that. If decisions were taken on the basis of the long and short, anytime it crossed 80 on either sides in the opposite direction, the strike rates have been 85%.
Understood. Got it. Let me try and get more sector specific. Where does this leave a sector like IT, Pharma? These are all defensives, traditionally. Where does this leave an IT and Pharma, which actually leans on export as an important revenue generator? So how should one look at some of these sectors and valuations in these sectors at the moment?
I think both of them are having divergent long-term fates. To my mind, Pharma, from an Indian standpoint, 8-10 years, it's going to go through a great transformation, structural change. Of course, last 3-4 years have not been so beautiful. But if you're looking at a sector which can be long-term, because most investors get lured by this intelligent conversation, especially in the mutual fund space. When I meet investors, they want to understand sectors. I said, what's the use of this information? I want to buy a sector fund. But if you want to buy a sector fund and not want to sell it, then it has to only be Pharma. Because IT we had called out last quarter, and then it did its 10% alpha on Nifty, and it came back down after this quarter results. So will a mutual fund investor be able to have the courage to book short-term capital gains, pay an exit load and get out of it in 3 months? The answer is no. So Pharma, from a mutual fund investor standpoint, IT, I think with some more correction, IT is definitely a sector which can give you a 5% divergence with Nifty in this calendar year.
Understood. And within IT, would you prefer the larger ones, the smaller ones? How should one look at it? Growth or the more stable ones?
I will take the smaller ones.
Understood. Got it. And how do you look at the whole banking and financial services space? You had the likes of an HDFC Bank disclose numbers, Federal Bank too disclose. What we're seeing at the moment in terms of trends is there's a bit of margin pressure, a bit of margin compression that continues to happen. How should one look at this, and what kind of bets are you taking there within banking, as well as you had the Bajaj Finance coming out with its numbers as well? So how should one look at it?
So I think we look at it as we get closer to the election, we will look at lower beta kind of sectors. And banking is throwing up larger beta, significantly larger beta, especially because of HDFC, what has happened over the last 4-5 months.
Sure.
But I think that if the largest index weight, which is Nifty, May 13.7 is coming from HDFC, there is going to be a lot of money chasing it. So I think it's going to be buoyant. How much ever fundamentally it may not look logical, but if you look at the kind of EPFO allocations which are to be made in the index funds, and EPFO invests only in Sensex and Nifty. And if you look at the weightage and then try and extrapolate what kind of influx can come and what is already taken by the passive guys, that's never going to move. So HDFC free float, to my mind, if you look at the implied free float, is very low because the passive guys have already grabbed that share and holding it. And if EPFO is going to put a few more lakh crores in the next 2-3 years, that not being buoyant is illogical mathematically.
Understood. Got it. So, from a technical standpoint, in terms of flows, you're expecting some amount coming into HDFC. What about some of the smaller names? And what about the NBFCs? How do you view those? Is there some kind of a risk there, especially when it comes to unsecured, as well as how should one look at investing in some of these NBFC names?
See, I think NBFC has been so divergent in terms of their NIM aspirations. The delinquency rates over the next 2-3 years could be very different for each of them. To my mind, you have to be very stock specific. And if I said something general on the NBFC, it will be very unfair on my part to make that statement on the full universe, because their aspirations are so different. If aspirations are different, and if there's something which is adverse, then suddenly you in NBFCs, you can have delinquency rates which were not even modeled. And so very specific, so no general opinion on NBFC.
Sure. And so can I say that your favorite sector at the moment is pharma? Is that what, from a holistic sector standpoint, that's what's looking most attractive to you?
Yes, pharma, which is executable recommendation, right? I would say cement is good, but it has be a coincidence for me to actually again have the same viewer being told that you have to sell now.
Sure.
It's too much of a luck for me to have that conversation again on that day when I feel like cement is done in stores.
Sure. And anything where you are seeing an excess build up in terms of valuation. So we had some amount of chatter with regard to PSU stocks and PSU banks in particular. Is there something that you feel is currently overvalued and that really needs to be exited right off the bat?
Yes, I think so many value stocks which were categorized as value, if you had a mathematical parameter to categorize them as growth and value, have moved from value index to the growth index. And I think if you're looking at any stock, which is especially PSU, you have to compare its long-term dividend yield as a valuation measure, which is not used adequately.
Fair.
People use price to book, they use several valuation methods, but if the dividend was the core proposition, and if looking at government's holding and dividend yield, if the long-term dividend yield of a certain stock is 4, and if it's trading at 2.5 today, I would be a little wary.
Right. So point taken there. And my last question will be with regard to how you are looking at the likes of a Nifty auto. That's been a counter which has somewhere been ignored over the last 2 to 3 years, if I can call it. And yet you have some specific names doing really well. You have the likes of a Tata Motors, which has really rallied extremely well, given very good returns to investors. So I'll try to cover one more piece here. Along with auto, if you can also give us your view on, if I can ask you a stock specific idea as well, ITC, because that's given a very similar rally to Tata Motors. Where do you see some of these larger auto pack names as well as an ITC? What should one do in this kind of a market?
See, from an auto sector, I would not be so qualified to comment. To be honest, and it would be unfair for me to speak when I'm not completely thorough. Now coming to ITC, there is a certain hypothesis that any time a stock's growth crosses the country's large stock, blue chip stocks growth crosses the nominal GDP of the country on a continuous basis for 2 years, there's a re-rating. If this hypothesis is tested with several examples, ITC is exactly a classic case of that. It started growing greater than the nominal GDP of the country for a successive 1-2 year period. Then the re-rating is enormous and the backlog of several years is made up. So if you believe that there is a stock which always did worse off than nominal GDP and there's a probability that it will cross that and stay there for at least a year, then re-rating becomes a very, very strong case to play.
Very, very interesting metric. And it's been a great conversation, Feroze. Thank you so much for coming in and doing this. It's been a pleasure speaking with you. And I look forward to doing more conversations like this with you.
Thank you, Harsh.
Cheers.